Would it surprise you to know that rates may drop even if the Fed does nothing? Let me show you this cool graph of treasury spreads. Okay, fine. I'm the only one who thinks it's cool, but hang with me for a second. We've talked for a while about how the 30-year mortgage rate and the Fed's rate are highly correlated. When the Fed makes a move, mortgage rates are usually close to follow. But let's talk for a second about how these two rates are different. For most of the last 30 years, a consumer could get their hands on a mortgage that was roughly 1.75% more than the rate that banks would lend to each other. Now take a look at the treasury spread today. We're sitting at roughly 2.85%, which is higher than it's been in the last 35 years. This spread is brought on by a bank's perceived risk, so let's break that down. Risk number one is that you refi. Banks want to collect on the interest that you say that you'll pay them, but if you refi, they're not getting that money at all. Risk number two is that the bank can't sell your mortgage. After they make money generating your loan in the first place, they sell it in a secondary market so that someone will service that loan for 30 years. Do you know who a major buyer of those mortgages is? The US government. And when they stop buying mortgages, that risk is transferred right back to the bank. And risk number three is commercial real estate. Businesses aren't leasing property the way that they used to, which means banks have loans that aren't getting paid. Now, this risk has very little to do with you, but it's the same pool of money. Here's the great news. Any positive change in those three risks could drop interest rates without the Fed doing a thing. So while the Fed may not make any moves until the summer, we may still see those drops in interest rates that we've been waiting for.